You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from a little thing around here we like to call the old Options Insider Radio Network. A baker's dozen worth of programs on the old network, including all of the well over 100 plus hours of archived footage, if you will, audio footage of the Volatility Views program. Where can you find all that great content, you might add? Well, a lot of places, including theoptionsinsider.com. That's where we have, of course, the Insider Radio Network tab. Click on that tab. You get the full overlay with all of the shows on the old network. And, of course, you can also check out our educational content, our analytical content, and just about everything else we have over there while you're surfing. If that's too much for you just want to find the audio, surf on over to iTunes or Stitcher or Aha Mobile or TuneIn or wherever you like to find your finer podcast programs will be there as well. Just search for the name of the show. If you want to get them all, just search for the Options Insider Radio Network. And if that wasn't easy enough, we even baked it into our mobile app available for iOS, Android, and the Fire OS. No shortage of ways for you guys to join us on the old program. And joining me on this program today, starting off with the man beaming in from the hinterlands of Maine. He does a myriad of things, wears a myriad of different hats. He's over there at the old pit educating some folks on all things volatility and VIX. He also does some fun, unusual activity for us. You may hear him on some of our programs on the network, in addition to this one as well. You know him, you love him as the Rock Lobster, Mr. Andrew Giovinazzi. Andrew, welcome back to the old Volatility Views program, sir. It has been too long.
It feels like it's been a dog's age when there was no snow on the ground.
Yes, that's true. It was many moons ago, back in the old days.
There's so much snow in Maine. I guess we could just take all the snow in Maine and fix the California water problem for the next probably 2 years.
Yeah, I was kind of wondering about that myself because we have all this debate now on what to do with all this snow in Chicago. And I said, it's a shame we can't just pile all that up for the inevitable summer drought that comes in the corn season and just spray that on our crops. I'm sure there's some nasty chemicals maybe in there too. We got to filter those out. But it's a shame we're trying to figure out a way to get rid of all this water in the winter and come summertime. We could certainly use that. So, c'est la vie. I'm sure a lot of people have had the same thought. A little bit hard to think to store snow for 3 to 6 months though. What's the carrying cost on many tons of snow, you think?
All I know is, let's see, what is it? It costs like energy in a fairly large hockey rink is like $500 a day in energy cost. So do that arithmetic, I guess.
I'm guessing you don't have to keep it as snow. You just have, let's say you have a dumb container. You just dump all the snow in, and then it melts eventually, so you don't have to worry about the temperature. As long as you got the water, then that's all you care about, right?
I guess we probably need as many buckets as they're storing all the extra oil as we do for the extra snow.
Yes.
Which is a strange thought when you think about it, about what commodities we care to build big containers for.
That is true. And listeners, we will be joined momentarily once we get his Skype issues worked out by Mr. Jared Woodard from BGC Partners. But now it's time for us to keep on rolling right on into the Volatility Review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, that funky tune always gets me in the mood to do some vol review, and this is indeed the portion of the program where we break down the week that was from a volatility trading and analysis perspective. And, of course, we are recording this on Friday, February 6th, for all of you out there playing the volatility home game, want to know exactly what week we're referring to here. And it was a bit of an interesting week. We actually had some action, had some vol and some vol this week. Not so much today, though. Most of the major indices pretty much unched on the day, non-farms and all that fun stuff. Not really getting the market moving. But the rest of the week, we certainly had some interesting days with spending the bulk of the days kind of vacillating around a certain level. And then, bam, it seems like in the last 10, 20 minutes, half an hour of the day, we just shoot off, exacerbating whatever that direction was to somewhat ridiculous extremes, moving 1% or more in a lot of those days this week. So it's been an interesting one to keep an eye on. Mr. Andrew, Mr. Rock Lobster, we will certainly start with you. A lot of things to sink our teeth into this week. What in particular caught your eye in the week that was from a volatility perspective?
Well, besides them just putting the weekend back into the market, I remember this. Remember those good old Europe days, it was like, what's going to happen with the euro? And they put the volatility back into the weekend on the Friday. Right now I have VIX up 87 cents. So a little bit of freak out. And basically the German foreign minister or finance minister told the Greeks, no, we're not going to do anything because we already have a signed document from you guys. But I guess that's just a signed piece of paper. Nobody cares about that anymore.
A contract is just an invitation to a lawsuit, sir.
Exactly. Well, the Germans don't think so. They're like, well, we can balance our budget. Why don't you guys try it? We have economic growth. We're holding the rest of you guys up. But be that as it may, we do have some volatility. Those days of rallying to all-time highs and VIX going to 13 and 12 or whatever are over. I'd say we got in a little whisper, like about 1% today. At the top from the all-time highs, 1.5%. And we retreated, the vol just cannot come down because I think we have a market of two stories where the U.S. picture is recovering. The Fed is getting out of the game. They'll start raising interest rates and I think that's what part of the problem was today. The jobs numbers were pretty good. Even with the unemployment rate ticking up, I think that's more of a factor of people trying to find jobs again. Right, because when you're not looking, you're like, well, I'm not looking for a job. Now I am. And those people will get added to the unemployment rolls. So that part of, I think that part of the picture is good. And stocks are going to have to adjust from the Fed getting out of the picture. And I think this adjustment period will bring us more realized vol as it plays out this year. But I just think you've got the current that's positive, which is the U.S. economy overall. Probably most of the global economies are doing okay. That's still a bullish case. But you have the short-term thing of, getting out of our zero interest rate environment and, the EU having to deal with the remote but possible structural effects of Greece leaving, whatever that does. I don't actually think it's going to matter more to anybody but the Greeks. And I think that's why we're kind of making, the market starting to push back or push a little higher, but at higher volatility. People are like, I kind of believe it, but I don't quite believe it. And that's sort of how things are priced right now, it feels like.
Yeah, you're right. It is kind of weird that they do seem to be putting a little bit of juice back into the old market is a little bit contrary to what we usually see. Most of the major indices today, right around 1 o'clock Central, and recording this, listeners, are pretty much unched on the day. We had the big number this morning, so usually that's a sign to let pretty much the rest of the cat out of the bag going into the weekend, and they're actually pumping a little bit of juice back into this market. A lot of the indices on the vol side are up, including the old VIX Cash, up nearly about 3/4 of a point or so to 17.68 here. So interesting to see that, kind of contrary to what we've seen in recent weeks, Andrew, that they're not just crushing it. Maybe there is some grist to this grease mill. You know, you're hearing a lot of talk about the whole grease thing now and how they're leveraging their position with Russia to try to squeeze back against Germany, and all sorts of great political machinations going on behind the scenes. Interesting stuff.
And I believe they're not allowed to take a loan from Russia because of where all the ECB and all those other basically owners of the debt, right, are standing in line. They don't want to be behind the Russians if anything goes wrong. So there's, you know, they're definitely trying to play whatever game they can to make it work. But ultimately, you know, we all know how economies start to work again. People have to go back to work. You got to create jobs, got to create incentive for jobs and stuff like that. And I think Greece finally has sort of bottomed out. It was starting to look a little better. But the problem is it just wasn't looking good enough for enough people not to, you know, vote in the Marxist-Leninist show.
You got to imagine there'd be a lot of unhappy campers in the EU if suddenly good old Mr. Putin would to jump to the front of the line of Greek creditors. That would be, I think, untenable for a lot of people in that situation.
I wish we could export natural gas tomorrow because, one, it would take the burden off the EU depending on the Russians for natural gas, and they could actually start being mean to that guy. But it's just too much is intertwined over the last 20 years for them to really do anything about it. All they can do is they're like a brother and a sister just screaming over the fence at each other, but not really much is going to change.
But you know, being mean to him has no effect because I'm not sure if you heard, but the CIA says he has Asperger's, Putin. So he doesn't really read the emotions the same way we do. So
he does the opposite.
Yes, exactly. He's cold, heartless shark. Interesting stuff. So yeah, before we get deep down the international politics rabbit hole, as well as all the nonsense psychological babble that goes with it, let's bring on our fashionably late guest, Mr. Jared Woodard, the derivatives major domo over there at BGC Partners. Jared, welcome to the show, and give us your take on the week that was from a volatility perspective.
Oh, first of all, I'm sorry I'm late. I'm really glad to be with you guys today because I think there's some really interesting things happening now that are pretty fascinating. I mean, we have to start with the economic data today because I can't imagine. I can imagine, but I can't expect any kind of a jobs report that would be better than this. It was a home run, obviously. Wages were up. Labor force participation was up, you know, as new job growth pulled people back into the economy, into the labor market. And this is consistent with, I think, the outlook that a lot of folks had, even some of us in the last quarter of last year, that as we saw job growth continue, we start to see wages, start to rise. The slope of those changes would become more aggressive, and we're starting to see that now, despite some really potentially misleading data from durable goods and the trade balance this week and some other kind of indicators. I mean, I think that's all great. I think it also maybe counterintuitively nudges us in the direction of a little bit more realized vol in the market, because you've got, while consumer demand is really surging, and there's more jobs and more wages for more people. At the same time, I think this report increases the odds of a interest rate hike this summer. Certainly, I mean, it's to me, in my mind, almost a certainty this year, and so there's some competing forces for companies. I mean, I think profit margins, if they haven't already peaked for this cycle, I think they will soon, and so there's, I think, real pressures, especially on companies that depend on high head counts and depend on cheap labor, which is some surprisingly large companies depend on those kind of things and have obligations to pensions and their dividend pays that are going to be a little bit harder to meet, especially as if margins start to start to come down. So anyway, I think there's some interesting things happening there. I think that can lead to more realized vol in the market, and so it makes for an unusual trading environment compared to what we've seen in recent years. I mean, I think that it's unambiguous that we have turned a new page in terms of what's happening in equity markets and what's happening in option markets, dependent on those. And so I think that this is a good time for folks who've had, maybe lackluster performance in the last 6 months to stop and step back and think about why that is and what, if anything, should be different. The other thing I'd point to is the cross currents in Europe. I know you guys were just talking about Greece and about Russia. I think there's a really interesting dynamic that I won't call it a catch-22, but it kind of has the feeling like that. Some folks still expect Germany to play hardball with Greece and to sort of, whether intentionally or not, push them out of the eurozone. I don't think that's likely. If it did, it might. There's obviously the kind of contagion risks that we're familiar with from before. If they don't, and if Greece is able to extract some concessions, which I think that it will, the risk on that side is that it emboldens radical parties in Spain and Italy, and Podemos, the sort of Syriza version in Spain, has become much more popular recently. And I think that if Greece is able to extract some concessions, I think it's going to embolden those other parties, and I think that's a risk that some people are quite aware of. At the same time, it's hard to be bearish on Europe here. I mean, they've had such a long slog already. In some instances, option premiums have been so expensive for so long that when you get numbers like the December retail numbers across the Eurozone, which were, I think, the highest level since late 2007, just a massive print in consumption there, I think surprising everyone, not least of all the Europeans, then you start to see arguments for a possible cyclical low, some possible economic upside in the short term there. And if we do see something like that, there's a lot of investors who've been positioned negatively on Europe for so long that I think that'll be a major surprise. And so balancing the risk of upside, even if it's just for a brief period in the European economy, against the tail risks in multiple ways from negotiations around debt and ultimately politics, I think it makes for a much more difficult but also more interesting sort of thing to trade. And so, like I said at the top, very interesting environment. We haven't even talked about oil or corporate earnings in the U.S. this quarter, but let me pause there.
Corporate earnings. So the next, of course, discussion point is that fantastic study you're working on for us, which we hope to see the results of very, very soon, sir. All right, I'll let you off the hook on that one, and we'll dive into some of the numbers we saw this week as well. You're right, it is a very interesting environment. Jared, we were discussing that at the top of the show, and some numbers do reflect that. We had a fairly wide range over in VIX land this week for the week that we saw. We said was fairly active. Low on the VIX cash side of about 1670 or so, 1667, and a high right around almost flirting with the 23 handle out there. Like I said, we're hovering right about a little few points shy of 18 handle right now, for like 817 the orders or so out there. So hovering right in the middle of that range right now. Looking over S&P land, it's been a bit of a volatile period as well. The 30-day vol out there about hovering right around a 15. The historical vol actually hovering around a 16 gets into that interesting discussion of the risk premium again, the realized versus implied. Going to get into that in probably a much more detailed fashion yet again, probably in the old volatility voicemail. So I suppose we'll table that for a little bit. We had a great discussion on recent shows, and so many of you wrote in with great ideas and suggestions and feedback that I have an idea that discussion isn't going away anytime soon. Looking over on the other side of the fence, the Skew index hovering right around about a 127.5 or so at the close of yesterday. And we've said before that would imply on the surface perhaps a little bit of reticence to actually come out and actually hedge. Given the high levels we're at, that might be a little bit surprising to you, but we've discussed on recent episodes as well how that number can be a little bit misleading and how just looking at it on the surface may miss what's actually at work out there in the old S&P Skew. Looking at the vol of VIX, it is hovering right around the 100 handle yet again. It's kind of been its vacillation point for the better part of the last week or so. It's been kind of hovering right a little bit north, a little bit south of that 100 level. Haven't seen any crazy spikes like we saw a few months ago, back up to the 140 level, then down to 90 again, where it was just whipsawing all over the place. It's been a little bit more steady, which is kind of interesting given the fact that we have actually seen some vol creeping back into that market, including today. Like we said, VIX Cash creeping up into a weekend. When's the last, with not much else really going on in the broad market, when's the last time we saw that happen? It's certainly been a while. Looking over there on the VIX options side of the fence, it wasn't, given what we saw going on in the underlying this week, you might think this would be a very robust week for VIX options, and you would be mistaken. It was essentially every day this week was well at or well under the ADV for this product. Now, ADV, of course, has come off quite a bit as well. It was well north of 700,000 for most of last year. This year, it's right around south of 500,000, actually about 475 or so. And yet, we still came in under that pretty much every day this week, except maybe for one, which kind of just hit it. There were some days with a couple 100,000 contracts going up in VIX, which, if you pay attention to VIX volume, you know is fairly anemic for this contract. And looking at what the hot strikes for the week were, the puts leading the charge again, which is kind of interesting, perhaps reflecting, again, where we are in that VIX frame of reference there. People can actually start lighting up some puts to the tune of the Feb 14 puts leading the charge this week with 322,000 taking the number one spot on our hot, most active VIX strike chart. Then we drop off a cliff by another 100,000 or so open interest down to about 224,000 for the Feb 25 calls. I'm trying to think, this might be the only second or third time puts have actually topped our list, which is interesting in and of itself. And the Feb 15 puts also getting some love, just a hair shy of 200,000 contracts open on that strike. Then we go down to the Feb 30s for the number 4 strike with 171,000 contracts. And we drop again about to 133,000 contracts for the number 5 spot, the Feb 16 puts. Then it's a put palooza for a little while here. Number 6 and number 7, the Feb 17 and Feb 18 puts with 128 and 118,000 open respectively. And the bottom of the list coming in all on the call side, the Feb 20s, March 25s, and Feb 18s with 107, 87,000, and 78,000 respectively. That last one particularly should show you just how anemic things are out there right now, listeners, because you know on most given average months for VIX, 78,000 contracts isn't going to get you anywhere near the top 10 for the hot, most active strikes, and yet this number 10 here with 78,000 contracts open on the Feb 18 calls. Total of about 4.8 million contracts open, about 2.86 on the calls, and just a hair shy of 2 million on the puts. So call heavy, but nowhere near as call heavy as it has been in recent months as well. Speaking of VIX options, they did just announce on their earnings call that they're going to extend the hours. They have definitive dates now. They've been talking about doing it for a while, extending the trading hours for VIX options and SPX options. Well, we have dates now. March 2nd for the VIX options, SPX options expected to start on Monday, March 9th. So file that in your record books if you've been waiting for some extended hours activity out here in VIX land. We mentioned the earnings call. We might as well talk about it. It came out this morning. CBOE earnings. Of course, CBOE is still the mothership when it comes to a lot of the leading volatility products, and you'd think this would be a decent quarter. They reported earnings up about 7.6%, but that wasn't enough to make the street happy. They missed their numbers. The stock's off about 5.5% right now in today's trading to about 61 in the orders or so. So not exactly robust times. Even though ADV was up, everything else you might expect was up. It still wasn't enough to please the street. C'est la vie when you're a public company. You got to keep those analysts happy. And apparently they failed to do that. Mr. Andrew, anything interest you here in terms of the extended hours for VIX, the anemic VIX options volume, or perhaps even the fact that CBOE taking it on the chin a bit today, even though it wasn't a terrible quarter overall for volatility products?
You're asking so many questions at once. You almost made my head spin right off my shoulders there.
That's my job, sir. I need to give you enough to talk about.
Holy gosh, what a radio host. I think the CBOE's done well to have their stock double since they listed it, considering what else has happened. That's not too bad for a sleepy old exchange. Is not too sleepy.
Yeah, I know a lot of people were pretty aggressively writing calls on the 30 handle, and that hasn't looked too good. So, yeah, they're trading at over 60 now. So all things considered, hasn't been a bad year for them.
No, not at all. As far as, trading extended hours, I think it's not a bad idea, but it's like anything when things get a little bit busier overseas. Maybe that might help eventually. I mean, I know I have a lot of clients that love trading options on futures. They like the overnight action. So I think that will only help them, especially in a product like VIX, which is sort of, I call it that's more of a macro type product, like a currency or a treasury bond, or, it's a big picture type product. So it will probably, I don't think it'll hurt. I'm just glad I don't have to deal with making markets or watching any screens, or I guess computers just do it all now anyway. So, but somebody's got to be minding the store. So I think that will be good. As far as the CBOE goes, they have two of the greatest, financial franchises in the world, and they keep riding them to glory. So I hope they can keep doing it.
Riding them to glory. I like that. Yeah, you're right. They've hit 2 home runs, and then they seem to have a lot of walks and swings and misses for the other ones.
Right. It's I sat on one of those committees as a market maker for a year, which is about all I could take, unfortunately, because it's very, very difficult to invent a new product. It's like anything else. I'm going to invent a new type of Triscuit. And the thing is, it's inventing that first Triscuit that's hard. And now they're Triscuits making tons of money because they got rosemary and olive oil Triscuits and sea salt Triscuits and all kinds of other Triscuits. So, I think the CBOE would do best to expand their VIX franchise as fast as they could, because it's out there. Everybody knows it. I have a whole lot of clients, which means not a lot of people actually understand it. However, it is out there in the marketplace. So the faster they could expand that franchise, I think the better they could do. If they could ever even trade them on some of the larger equity products, I don't think that would be a bad idea either. Although I would imagine liquidity in that stuff would be difficult. So, and I know we've talked about the Russell is launched, the oil volatility is launched. So those products are out there, but I think what made the VIX ultimately successful was those futures got a little more liquid. Then you have some ETFs trading the futures, and that's the kind of, you have to create sort of an ecosystem around the product to have people continually sort of orbit around it to some degree. And I think that's what worked with the VIX. I think that's what's worked well with the SPX and the SPY and things like that. There's a lot of these products that are related. They are a high impact for a broad part of the population, and I think they need to keep pushing in that direction. Even launching maybe some ETFs themselves on their own products. They might as well beat people to the punch, as far as I'm concerned, because they own the Chicago Stock Exchange, so they got the place to trade them.
There you go. Some little advice for them. It's funny you mentioned the expanding the VIX family, because they have tried to do that, obviously, including on the single name stuff. And they had a lunch here in Chicago a few weeks ago, and I was chatting with their CEO. And that's pretty much the first question I put to him, as I have many times. I said, when are we going to see these single name VIXs that you first disseminated years ago? Apple VIX, I think it was Apple, GLD, and a couple others, Google and a few others. They were talking about disseminating VIXs on. They are disseminating VIX values on. In fact, our buddies over there at Schwab, that's where they get their Idea Hub trade ideas from, single name VIX values. And I said, when are we going to see these products actually trading? And he actually said, and to his credit, he's a former market maker, so he has a handle on this stuff, which is nice to see a former market maker in the executive suite of one of these exchanges. It's a refreshing thing if you've been around these exchanges for a while. And he said, actually, it's been interesting to watch the way they develop and the skew of these products. And when it comes to like a single name product like an Apple, it doesn't really perform like you would think. There are some weird aberrations to it when they get into and around earnings that kind of screw up the calculations for their product. So he made it sound like the environment for a single name like an Apple VIX wouldn't really perform the way you'd think, and it wouldn't provide as much utility, which is why they've kind of held off on launching it, even though you'd think that would be a slam dunk home run. Apple VIX, particularly like a year or so ago, would have been, what would have been the hot product of the year, you'd think.
Well, I think what he's saying, because Ed is, I met, I mean, he was a market maker when I was a market maker. He was a little older, super nice guy. But he's like, what are you gonna, where are you gonna price Apple VIX, the day before and the day after? How's that future going to be priced? I mean, the vol is going to be 40, but the VIX future is going to be trading 22. It's very it's very hard to price a cash index in the future because everybody's just going to be selling the crap out of it. There is nothing that is not as sure a thing trading as a drop in volatility the day before and the day after earnings. So that's just a fact of the marketplace that is very hard for them to deal with. The one thing why the other products have basically been, relatively successful, the VIX obviously real successful, is, there's a lot of noise in the futures, but that only happens in severe market dislocations, and it's not predictable. How do you know when the VIX futures are going to go backwards? I don't know. Are they going to go backward tomorrow? Well, maybe Monday if things get worse in Greece. You never know. So, but with an earnings product or with a single name, that vol is going to be lower the next day. So that's a lesson for everybody on the difference between Gamma and Vega, because the Vega is a very sure bet. But the problem is it's very hard to do that without having to take it on the chin with the Gamma part of the option somewhere or another. So I think Dave, he knows what the game is, and it's just I'm not saying that their job is easy to extend their VIX franchise, but that is clearly the volatility franchise that needs to grow. And right now I don't have an answer for them how to make that easy one way or another. So it's a tough one, or you just accept the fact that future is going to be all cockeyed going into earnings, and that's it.
Well, they've already made their peace with regular VIX settlements. I'm not sure why can't they make their peace with a VIX Apple crazy settlement, particularly around earnings. People are already used to that kind of wildness. So maybe it wouldn't be that much of a surprise. Jared, there's obviously a lot of grist for the mill there in that very, very wide-ranging conversation. VIX volume being somewhat anemic given everything we saw over the past week. The strikes also being relatively light from an overall volume perspective. CBOE coming in with earnings on a quarter you might have thought they did all right, actually missing their numbers. That could be your take on analysts as well. I think we here on the network tend to have a dim view of analysts overall, but maybe you're more optimistic than we are. How they fix these product suites, a lot of grist for the mill there. So what really catches your eye on all of that stuff?
Well, I think there's been a if you take the change in investor behavior with respect to selling volatility, you're trading covered calls or doing put rights, and the way that folks have changed their approach in the last 4 to 5, 6 months. I guess a bit of a miss on earnings may not come as such a surprise. It's interesting. I mean, I know that I've followed the equity analysts on the CBOE since they listed it, and for a long time, the estimates were consistently undershooting, and every quarter they'd surprise and they'd just trounce what people were, and the stock price would just surge well past targets. And so sometimes people would dig in their heels and keep a lower price target, and the stock would just kind of shoot higher. And now it seems that we've with the decline in VIX volume and VIX futures volume especially. I mean, VIX futures is one of the biggest contributors to CBOE earnings, and the fact that if you look at those CFTC weekly reports, the amount of activity has fallen off considerably, both on the speculative and hedging side, long and short side, from where it was, say, in 2012, 2013. So, but again, consistent with the, an outlook for rising to, moderate volatility this year, there's probably some room for a resurgence in those products. I think that the lack of participation from a certain Pacific Coast investment company in the vol selling market the last quarter of last year may have been a more significant factor than some people were expecting. I mean, I know that the company of which I speak was quite active in the options market, not just in fixed income but in equity too, and the fact that their leader has moved on, I think, has meant some changes in that approach, and that has lots of different effects in the market. So what I do think is interesting, what I hope we see, I hope that 6 or 12 months from now we're talking about this in a really positive way, is the Treasury vol futures. I think that's a great product, and it hasn't become all that active yet. But I think that possibly this summer we could see a resurging interest in trading fixed. I mean, obviously fixed income and currency and commodity vol have all been rising pretty steadily, and so the use case and the demand, I think, is probably there. It just remains to be seen whether folks are going to be satisfied with the liquidity and the depth that exists in those Treasury vol futures. So, but I think the exchange has a good plan in place. They listed those new currency vol indexes on what the euro, the yen, I think the British pound as well recently, and so they maybe a little bit of jealousy of what's happening over the CME in terms of volumes on those asset classes. But I think they're right to put some renewed attention there and not just be so equity centric. So we'll see if that leads to tradable, meaningful volume. But at the very least, I think in terms of analysis and index dissemination, they've got some interesting things going on.
It would be fascinating to see a product like an Apple VIX and be able to trade and see what discrepancies emerge between that Apple VIX product and the actual front month or front week Apple products going into earnings. That would certainly be some interesting fodder for trading, I'm sure, and I think that would be fun. So I hope they get that ball rolling. You mentioned the commodity stuff. We've been gassing on about equities for a while. Time to get into the commodity realm, and it was, of course, oil story yet again. And the oil story seems to have solidified around the battle on that 50 strike. That's where they're hovering back and forth. Of course, they dipped in the end of January right down to around the 43 level. Has since bounced back quite a bit. They rallied about 20%, got over the 50 handle, then got cut again, the biggest one-day clip they had since back in November, then have rallied again. Right now they're hovering about a point or two north of the 50 handle in most of the major futures contracts there. So seems like the north of 50 crowd is winning, but that volatility has been interesting to watch over and over again. Mr. Andrew, perhaps we'll start with you. I know you like to watch USO primarily, as well as XLE and some of the other broad-based products. What caught your eye out there from a vol perspective and in any of those products, as well as, of course, the big WTI and crude products?
I don't remember the vol being this high even when we invaded Iraq. I think it was higher. The vol went to 100 and something 50, but we haven't seen it like this just from movement in a very long time. I think we had like a huge short covering rally, it feels like. But a lot of the other oil drillers and stuff, vol is still high in all of those names, like Rig, Noble Energy, take your pick, even Exxon, all of them, the drillers, the explorers, the energy producers. So I think honestly what that's saying is nobody knows what the heck is going on with oil. And it's still very much like that. It would not surprise me if oil went back to its lows next week. Why not? So at least right now, I just think the volatility is high for a reason, because right now it's trading like a 50 vol product. I mean, the realized volatility is over 50 for most of the oil linked products. And it doesn't look like it's going to go away anytime soon. If it's moving, $3 or $4 a day, which is what gigantic moves considering how big the oil market is. But that's what we've got. We have a product that's moving quite a bit, and it does not look like it's going to stop anytime in the future.
Yeah, that the CBOE, the crude oil VIX has been moving quite a bit as well. It's off about 3.5% today itself. So there has been just some vol out there in crude land over the better part of the past week. It still seems like there is that shaking out process. It was at the bottom, 43, whatever it was, 89, or is there more to come? Are we south of 50? Are we north of 50? That seems to be where the big battle is settling out now. We're starting to see that in the skew of some of these products as well. Mr. Jared, it's been a fun week to watch from a commodity vol perspective. What caught your eye out there in oil land over this past week?
Well, so oil got a bit of a bounce, and as a result, I think there were some folks scrambling to cover directionally. Implied vol actually rose, even though as the commodity was kind of having this counter trend, bit of a reversal, which is not a big shock or anything. I mean, you have I think it sets up in a situation where the folks have been leaning into this trend pretty aggressively, may have had to rebalance, and on an intraday basis, I think there's some good evidence of folks who have option positions on trying to keep their exposure within manageable levels, and how that's affecting the market, I think is possibly even discernible intraday. You've got, some people delta hedge at fixed, price levels, so round numbers, things like that. There's been so much exposure built up, just anecdotally from clients I've talked to who have positions in options on oil, and anytime you have these big changes in trend or end conclusions of a trend, it means that folks who have short straddles, short strangles have to either at least execute or possibly even change their delta hedging regime. All of that said, that can contribute to realized vol in the underlying. But even on a closing basis, I mean, you've got 1 month realized vol in what, like the 70s, I think 70% or so annualized, and there are not that many occasions historically where we've gotten that high. I mean, 2008 certainly, I think 1998, maybe 2001, 2003 perhaps. I mean, there's a few episodes I can think of where I'd have to check the chart later, but I know there's some cases where we've seen crude vol get up here, but it doesn't tend to stay high for very long, and so I think this is a point now that we've seen some buyers step in to reconsider fundamentals. I know a lot of people are interested in potential value opportunities, both in equity and in high yield credits. In options terms, that could translate into an evaporation in crude implied vol if a really big bid starts to develop under the market. But you haven't seen the kind of reduction in supply yet that, as far as I can tell, that would justify expectations of any major new rally, any major recovery in oil prices. So if we do see more continuation on the upside, there might be a good case for selling some of the call wing, some of the call skew up there. Again, assuming that the fundamental picture doesn't change dramatically.
All right, and that's going to do it for the volatility review. And I want to make sure, a lot of you guys have been writing in. I want to make sure at least get some time to give you guys a little bit of time on the old show. So let's dive right on into the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL, posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, going to kick things off with, let's see here, so many to choose from. Let's kick things off actually with a reply to a question we talked about last week on the show. It was someone who wrote in from StockTwits. It was Nitin, I believe his name was, Nitin Gulati. And he wrote in saying, hey, what we saw happen in GOOG, the options and the underlying afterwards, wasn't a surprise given what we saw out there in the Google Skew. Andrew, you missed this show, but listeners, you can't see the chart, but if you look it up for yourself, he sent out a great chart showing the Google Options Skew and showing how most of the months were relatively flat from a pure premium perspective. When you get into that near-term front month kind of product, the calls were dramatically bid relative to the puts. So he was saying, well, clearly that near-term love for the calls is why Google initially dropped 10, but then rallied really hard. And we kind of dissuaded him of that a little bit on the show and said that's probably not the case. But it was a good opportunity to do things like legging in to verticals for very, very attractive prices. And he wrote back to say, here's my counter argument. Well, first off, he says, I love the Vol View show, so glad. Thanks for listening there, Nitin. He writes, here's my counter argument on your remarks on skew shape. If everybody is hedging their short bet, the vol squeeze is very likely, which is exactly what happened in GOOG post-earnings. Yes, at-the-money call spreads were the best plays in case it was a win-win situation, but blowout numbers and an upside explosion with so-so numbers covering their... blowout numbers equals upside explosion, so-so numbers equals covering their shorts. What am I missing? Well, it's interesting, excuse me. Interesting. Thanks for following up there, Nitin. And it was a fun one to watch and a fun one to keep an eye on here. GOOG, of course, being one of the more interesting names we've seen reporting this quarter. Mr. Andrew, I know you missed the show last week. I had my chance to weigh in already on Mr. Nitin's comments. So what do you have to say for our friend here? And the notion that near-term vol skew with the heavy emphasis on the calls therefore predestines the fact that GOOG is going to rally post-earnings.
Well, it's that's a good the fact but he's right in the fact that that's where the demand is. I mean, buyers want those out of the money calls. So they're looking for a lift in the underlying. And generally in the old days in Google and in Apple even, we saw that crazy upside skew. So generally skew is there because there is an preponderance of buying or selling in a particular place. So in that way, that's all I would say is it's the skew is predictive in the fact that it's telling you what people are, how they are shaping their bets. And if there's a high upside, if there's a kind of what we'll call more parabolic type upside skew, the bet shape is I want to own it. And most people want to own it when they think they have a pretty good handle on, what fundamentally might be happening with the earnings picture. So in that way, I would say, yes, the trades that seem to work best for me like that are trades where I buy the near the money stuff then and sell all that out of the money stuff so I can, you can gain from a lift or a trade like a butterfly or something like that would gain from a big lift in the stock. So that's all I would say there is I can't really, it's just the fact that the skew is there doesn't mean the buyers are right. It's just telling you, where the paper is placing their bet. Where's the emphasis?
Yeah, if that skew was always so predictive, we would have seen Apple always move hundreds of points post-earnings. Granted, it did quite a bit, but then that kind of settled down for a while afterwards, and people were still buying those calls in pretty hefty numbers.
But it looks like it right now, and if you looked at the picture in Google right now, the skew does not look anything like that at all, right? It's kind of, I believe anyway, it's got a near flat upside 30 days out. You got 18.5 vol to March, and I'm just pulling up the skew as we speak, and I'm looking at an early March cycle, and it's a very, very flat downward sloping skew. Like Google just does not have any upside oomph in it at all. And, to me, that's always actually from a position point of view, that's always been an opportunity to buy very cheap calls and then sell calls very close to them, kind of create a ratio spread. If you think you're going to get a move, because you get a really small dollar, you basically get an upside bet for a couple of weeks that costs you minimal theta dollars. And if it blows up in your favor, woohoo, you win. So, and that actually is starting to look like that again. The market with this grease thing it's all like it's been that type of rubber band, and maybe a name like Google will benefit a little bit because it hasn't done diddly squat in a year at least. I think Google's actually down for trailing 12 months, as I recall. So at some point, somebody's going to want to, oh yeah, it's down like, 10% over the last 12 months. So, from that point of view, that's a name that might want to get back to some decent levels again. So, but as far as earnings go, the skew is telling you where the buyers are. And there'll be a lot of times on an earnings cycle where nobody wants those upside calls, where they're actually, there just isn't really a bid for them. So it's one of those things where skew tells you basically, I use this euphemism where skew corrects the at the money. So if there's a lot of upside call buyers, that's people saying, well, maybe the at the money vol is not expensive enough. And if there's lots of sellers of the skew and it's very flat, pushing it down, that means traders are basically thinking the at the money's high enough and they're not going out on a limb like that. So that's how I think of trading the skew, and I traded it when I was a market maker, and it seemed to have worked for me. But It might not work for everybody.
I think we all can agree that is perfect for legging into verticals. That's a good thing. I think we can maybe disagree a bit on the sucking power of that skew, whether that's going to every time pull that underlying up there. I mean, maybe he's conflating a little bit earnings and expiration. You certainly see some gravitational forces around heavy strikes and heavy skew areas in expiration week, because that's a crazy week and things are expiring and things are moving all over the place, and gamma is nuts and theta is nuts and everything is kind of thrown out the window at that point. Earnings a little bit different story. There's still some meat on the bones usually with those options, so they don't tend to migrate as aggressively. Interesting. You fall in the Nitin camp. If I recall, I believe Mark did not. So maybe a little bit of trouble in paradise over there in the old option pit land. You two agree?
Well, is he saying? Was Mark saying there's no? I'm not saying it's predictive. I'm just saying that's where the paper is on that.
Well, yeah, I think we can all agree on that. That is where the paper is. Yes, indeed, that's where the paper is. We can agree. Okay, we'll move on. We'll move on to the next one, lest we keep going on this one. I want to get a few more in here. Question come up from Uncle Ben. May I say, by the way, you have very tasty, delicious rice, sir. It goes on to say, liked the discussion on risk premium from the last episode. This is the topic I've always struggled with. It seems like you're chasing your tail either way. If you compare straightforward 30-day implied vol versus HVOL, like we said on the last show, then you're comparing an indicator that's really 30 days forward with an indicator that is nearly 30 days lagging. Doesn't make much sense. If you attempt to extrapolate realized volatility forward, you run into the same errors that plagued implied volatility. There are millions of dollars spent on volatility forecasting models that can't get it right. So what chance do I really have with my own little algorithm? Is this all a fool's errand? And really quick, let me wrap another one into it because it's kind of related. We had a lot of questions on this topic. Comment from someone, a listener goes by the handle Alvo. He writes and says, hey guys, just a note that 30-day historical vol actually measures about 20 trading sessions, while 30-day implied vol goes out a full month. Different size data sets equals problems. Quite a few of you actually pointed that out. That's a great point, actually. You have different data sets you're dealing with, so that already is going to kind of skew your numbers a little bit, and you have to do a little bit of math to even those out just before you even start. So great questions, Jared. I know you. This falls right up your alley, so I'll give you pride of place here. What do you have to say to our friends, Mr. Uncle Ben of Delicious Rice fame and Mr. Alvo?
Yeah. So no, you're right. These are good points. I mean, this is a really important both of these points. I mean, the second one actually is not news. I mean, there's calendar days and then there's business days, and you do have to account for that. And everyone that I know does. So.
I don't think we pointed it out on the show. So that's why I wanted to make sure we did it.
No, I mean, it's an important thing to be aware of if someone's, kind of not, I mean, you can, I don't want to trivialize this because you can actually get yourself into a whole mess of confusion if, let's say, you have a spreadsheet open and you're filling down your columns and you're not aware of, what the time horizon is of a variable that you're measuring. So point taken, it's an important point, and in our software or in our spreadsheets, we all have to take account of the difference between business days and calendar days. Absolutely. With regard to the implied versus realized, let's say the direction that they're looking, with implied looking forward and realized looking backward, this does present a problem. And I think, look, if you wanted to go all the way and say that a conventional ratio of implied and sort of trailing realized volatility is in some sense kind of a useless thing, at least in some situations, I would agree. I mean, there's lots of instances I can think of where the price volatility of recent history covers some events that just are not likely to be repeated in the near future. That and in the options market, which is looking to the future, maybe pricing in something that hasn't been reflected in price history yet. Earnings is the obvious example, but lots of other, any kind of macroeconomic risk situation, lots of idiosyncratic things relative to a particular security, whether it's a corporate leader or regulatory filing, all that kind of stuff. Obviously, obvious candidates where these two variables might not sync up. But even in trivial cases, I mean, I want to press the point here because I think it's a great point, and I'm actually working on a project to address specifically this problem. So I feel kind of lucky to get to pitch the value of it in this context. I mean, there are lots of cases where there isn't some obvious event, some FDA approval or earnings or CEO has a heart attack type situations where none of those are on the table. and you still can't get the kind of value that you want from especially a realized volatility measure. Part of it is just like the arbitrariness of calculation windows. So we say, let's look at the last 1 month's worth of trading data to estimate volatility. If something bad, if there was a big move in the stock 19 days ago, such that it's still in our 1 month, say 20-day or 21-day window, why should that move 19 days ago be really important right now in our estimate of realized vol, but suddenly become entirely irrelevant in a couple business days when it falls out of the calculation window? I mean, that's not intuitive at all. And
21 days, that's meaningless, Jared. I don't know if you know that. That's moot.
Right. It becomes totally irrelevant, whereas earlier it was absolutely essential, right? So that kind of jumpiness, is not helpful. And if you say, well, I'm going to widen out my calculation window then to kind of smooth things out, that's not really a solution, because now you're just including more data and smoothing it, yes, but not giving importance to more recent data that might actually be relevant. So, I mean, there's some not too terribly complex methods for smoothing out and arranging this data in a way that's, I think, a bit more useful. And I'll have something on that for clients probably in the next month or so. But even absent that, I mean, yeah, point taken. It's something that that you have to think about. I mean, and there was actually a part to that question from Ben that really pulls at the heartstrings there. He says, people spend all this time and effort trying to forecast volatility, coming up with new models. What chance do I have in doing my own work of doing anything better than that? And you feel the emotional tug there of a lone market participant trying to sort of make his way in the world, and I'm right there with him. But the good news is, I think that there's lots of models that are actually pretty valuable that are publicly available in academic papers, and in some cases in software platforms that you can use to kind of get an approximation that's a little bit closer to the truth, closer to what you're looking for. So it's not, I don't think there's much hope for someone who's trying to create something from scratch or kind of reinvent the wheel. But I think that the good news is that there are some wheels that work, that roll pretty smoothly. And just because something came out of an academic department or came out of some kind of a hated investment bank or some other kind of institution, I don't think people should discount the work from those kind of places, because they do spend a lot of time and effort trying to improve models, and in some cases, as I say, I think they're pretty good.
Never let it be said that we can't tug at the heartstrings here on the old Volatility Views program. Anything to add there, Mr. Rock Lobster, before we wrap it up here for this episode of Volatility Views?
All I would say quickly is when I'm just teaching students about volatility, and they're looking at when do you think vol is cheap or expensive? I always use the relative realized vol and implied vol to give them a snapshot of what's been happening lately. So my question to you is, do you think the next 20 days are going to be as volatile as the last 20 days are going to be as volatile as the next 20 days? And if realized vol is at an all-time low, I'd say most likely not. But it could stay that way for a while. So what you have to do is, I think it's more important to look at where the market is pricing, the kind of the forward implied volatility, however far that is in the future. And you're looking at how the market's just moved and say, how sustainable is that? And what you can do is, once you start getting a relative sense of where things are, you might have a trade or not. When you're in an environment right now, I think the volatility is kind of fairly priced everywhere. I think next week could be 18 vol. I think the week after it could be 18 vol. So I don't think there's a lot of edge in trading volatility per se right now, because the way I look at it, until some of all these other issues are cleaned up, we're going to have markets are still going to be zipping all over the place, which means there's different types of trades that I'm looking for. So what I do is if you're looking at volatility, you want to make vol trades, you see what's the market giving you today in a relative sense, and does that look cheap or expensive or not? And it's just basically, I think what Jared was pointing out, it's where you take your frame of reference from. How long are you going to be in a position? And I think if you're using 60-day vol, well, what do the last 60 days look like? Are they going to look like the next 60? And I think, really, if you're trying to do any sort of predictive, I mean, even looking at a predictive indicator, I would say it's pretty hard to say with mathematical certainty what the next 60 days volatility will be. Because if somebody had figured that out, they would probably have all the money in the world by now. So I would say it's still just a game of understanding where the vol is, how the market's pricing it, and will the short-term future be as volatile or less volatile than your just recent history.
All right, that's going to do it for this episode of Volatility Views. Thanks to everybody who wrote in. We love to hear from you guys. We still didn't have a chance to get to everybody, so keep those questions coming in. We'll make sure we work you in to upcoming episodes. And before we go, as always, let me check in really quick with each of my cohorts here on the old Vol Views panel, see what they have cooking. Perhaps we'll start with you, Mr. Jared. You gave us a bit of a tease of what you're working on. Anything else cooking up over there in the land of BGC Partners?
I'm working on a couple things that people might be interested in. There's a better measure of realized vol is the name of that project, trying to deal with exactly the issue that the listeners were identifying. I think we've found a good workable solution to that that's tractable and tradable and not hard to calculate. And then I've also been looking at outperformance this year in companies that have revenue focused in the United States. So kind of a Fortress America on the corporate earnings side of things, kind of a model. There's been so much weakness internationally that companies that depend on the American consumer and not so much globally for their revenue have outperformed, and I think there's a good case that they'll continue to do so, given the economic data we've been getting. And I've been looking at how to take advantage of that in the options market, and that's probably going to come out in the next week or two as well. There's also one last thing. Really interesting divergence in correlation happening right now. The implied correlation in the S&P based on index options relative to what's happening in realized correlation among S&P components has been diverging all year. And the spread, I can tell you, because I was just looking at this before the show, between those two measures, when we talk about the implied versus realized spread, well, this is implied versus realized correlation, is in the top decile, the top 10% of values for the last 3 years. So it's an incredibly unusual situation, a little bit difficult to take advantage of, a little more trickier, but still tractable. And so I'm going to write about that as well. So lots of things I think that are pretty interesting coming down the pike.
And same question for you, Mr. Rock Lobster. What's coming down the pike in the land of the pit?
Oh, well, what do we got? We're going to be starting our weekly webinar series or our monthly webinar series again. So look for that from us. We just started our platinum course again. And, basically kind of just rolling along. We have got our new website kind of up and running. It's mostly for people inside of Option Pit. But you will start seeing more like 3-hour webinar series from us on a little and more intensive topics, actually similar to the realized implied vol discussion that we just heard. We just talked about a little today. So all that stuff, and it will be available in a digestible form from our web store. So if you can't make or can't kind of be a part of Option Pit every day, we're going to make our products available. We have quite a recorded library, and people can just kind of come into the library, pick and choose what they want to read, and it'll be at their leisure. So hopefully that will resonate with the trading public at large. So look for that within the next month or so, now that we got the backbone of the site all kind of set up for it.
All right, thank you for that. And on behalf of Andrew and Jared, and of course myself, I want to thank all of you out there in the listening audience for indeed downloading and streaming and subscribing, and of course for sending in such great questions with such provocative handles. Keep them coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/The Options Insider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.